Good evening to all of you. Welcome to our class today. The last time we met, if I remember, and someone may correct me, we were discussing on time value of money. Is that what we were discussing last time?
Yes, we were.
Yeah, okay, fair enough. Okay, that's what we were discussing last time on time value of money. So I want us to attempt a question that is simply asking us to apply the concepts of time value money. Okay, before we discuss the discounted cash flow techniques, I want us to discuss some of the questions that your examiner has tested in the past, asking you to apply the concept of time value of money. Okay. So let me go through. I'm going through the question bank currently. Okay. We attempt a question where your examiner had asked you to do that, to apply the concept of time value of money. Okay. So I'm going through your question bank right now. So should you be doing that? It's a very simple question, but if you don't know the concept of discounting and compounding, then the question can be tricky for you. Let me try to see where the question is. So the question is simply asking you make a comparison as to whether the company should sell its building today or wait until 8 years from now. That's what the question looks like. I'm here to get it. Here it is. And this question, I don't think you have it. It's from December 2013. December 2013. So December. Okay, so December 2013, question 2D. December 2013, question 2D. So let me share it with you on our WhatsApp forum. Okay, so I'm sharing to the WhatsApp, so check it out. Yes, okay, I've shared. So go through it on that company called Bamba Limited. Go through it, then we discuss together. Okay, I suppose that you have gone through it. So you've been asked by the examiner, advise the management of the company on whether to sell the building now or rent out the few offices. Okay, so in case you can begin with, assume that the company is going to sell the building outright. So this is sale of building. Okay, sale of building today, T note. the amount which the company will be receiving is equal to allocation imagine intended to sell for 8.4 million. So if we decide to sell today, you'll be getting 8.4 million. Then the other alternative is you rent out the building for 8 years, okay, and every year you'll be getting 160,000, okay, and at the end of year 8 you sell the building, okay. So here let me call it renting option, okay, or rent option. If we decide to do that, then of course you'll be getting rent for 6 years, for 8 years, okay. Therefore, we can say present value of rent to be received, present value of rent to be received is equal to 160,000, okay. Since you see this is 160,000, it's an annuity, because the rent doesn't increase. So this is an annuity. So we're going to be discounting as an annuity times present value annuity factor 8 years. We are discounting, we are compounding, because this is a compound. We are discounting the cost of capital, which we've been told is equal to 5%. The cost of capital is equal to 5%. Okay, this will be equal to 160,000. Did I show you how to use the tables?
Yes.
Okay, fair enough. Okay, so I'm going through the table. So the factor for year 8 years, 5%. Okay, don't forget to use the annuity table. Okay, so 8 years, 5%, 8 years, 5%, 8 years. I get 6.4. Therefore, it was 6 times 6.4. 5%, 8 years, 4632. Okay, I hope you can all see that. The factor for 5%, 8 years is 6.4632. In case you don't want your table, that is a formula for sure. Okay, and you get how much to be the present value of that annuity?
1.034.
Okay, 1 million.
1,034,112.
112 that way.
Yes.
Okay, so therefore we get for the present value of rent that this company will be receiving to be equal to 1,034,112 shillings. They're shillings, no, they're not dollars. These are shillings. Okay. Okay, then you get the present value of rent. Don't forget, if the company decides to take this renting option or this the option of renting out the building, at the end of year 8, they're going to be disposed. They're going to sell this building and get some money. Okay, so you may want to determine therefore what is going to be the selling price. How much will the company get from the sale of the building at year 8? Okay, so you can say therefore selling price at year 8. Okay, because at the end of these 8 years here, okay, you're going to sell the building, and you'll be told that the price of the building is increasing by 3% per year. And currently, it is 8.4, okay, which I think we have it here. Therefore, at year 8, the selling price will be 8.4, the current price, but the price has increased by 3% per year for those 8 years. So it's like we are compounding, okay, times 1 plus R, 1 plus 0.03, because they increase is 3%. The increase in the price of the building is 3% for 8 years, the power of 8, okay, for 8 years. Then what will be the selling price at year 8?
10,640,869.
That way, 10 million.
69.
10 million 659. Confirm my
10,640,869. 869. Yes,
right.
like that.
Okay, fair enough. Look, for this is going to be the amount the company will be receiving from the disposal of this building at year 8. But don't forget, we want to get the present value. We want to make a comparison between this alternative and renting. But this is at TINOL, this is at today, and this is at year 8. So of course, we need to discount back to year 0 to determine what's the present value of this money. Okay, so let's discount back to year 0. The present value of the sales proceeds of these sales proceeds, okay, which will be received in year 8, will be equal to, you're going to get 10,640,869, but at year 8. But don't forget, the selling price, you only get 1. So this is a single cash flow, which you only need to count back to year 0. Therefore, times present value interest factor, 8 years, 5%. Don't forget, this is not an annuity because you only sell once. So this is a single cash flow. So therefore, we use the first table. Okay. Therefore, this will be 10,640,869 times back to the tables. 8%, 8 years, 5%, 5%, 8 years. You get 768. 768. I hope that is okay. 5%, 8 years. Got the factor. Yes, 6768. Okay. That can therefore the factor. We discount back to a 0, we get the present value. They are in shillings, not dollars. And you get how much in shillings?
We get 7,201,740.
740.
Yes.
Okay, we get therefore the present value of the amount you'll be receiving in case you are to decide to rent the building and sell it off at the end of your age. Get 7 million. But don't forget, you will also get the rent. Okay, and the rent, we think we have decided, we have calculated and obtained its present value. Is 1,000,000 and that 4,000. Now, combined wise, how much cash flow therefore do you have in present value terms? And be equal to the present value of rent in option will be the amount you receive from the sale in present value term, so in 40, plus the amount you get from the lease, from the rent you receive, 1 million, that 4,000. So have it here on top, that 4,000 and 112. And you get how much is the present value of those cash flows? 8 million.
8,235,852.
852. Okay, to get 8.2 million free. Okay, now we can make a comparison. This is the present value of cash we receiving in case we decide to rent. What if we decide to sell today? Okay, we get 8.4 million, isn't it? Now we compare which one is going therefore to be the better alternative. Okay, of course, the one is going to grant you more or higher wealth, okay, higher value. In the case therefore this is 8.4 and this is 8.2. By default, the company should therefore sell the building today. Because in present value terms, you get more money. Okay, here you get 8.2, but in case you are to decide to sell off the asset, you have obtained 8.4 million. Therefore, you advise the building, the company. Okay, so the advice: the company should sell the building today. The company should, okay, sell the building today. Or now, since the option yields the highest present value of cash flows, okay, at 8.4 million. Okay, and that's what you meant to do. Simply apply the concept of compounding, discounting to make the decision as to the company should sell the building or the company should buy the building, should sell the building or should rent out the building for 8 years. Clear? Question? Okay.
A question. Okay. I didn't understand why the first part we use the I think the present value, the AF, and then and then now the second part we've used the PVIF.
Okay. The difference is that the rent, you're getting rent every year, isn't it?
Yes.
Yeah, so the rent you're getting is 160,000. Therefore, it is an annuity. Okay. So every end of the year you get 160,000. Every end of the year you get 160,000. So you can decide to discount the rent individually, but those will be 8 discount you'll be doing, which doesn't make any sense. So the best thing, of course, is to use the annuity formula. Okay, which I think we have discussed together. So the best thing is to use, therefore, the annuity formula. Okay. If you don't want to use the table, you can use the formula. Okay, which I think 1 minus 1 plus r to the power of negative n divided by r. I think you'll all remember that. Okay, but that's good. Okay, so since you have the table, just use the tables. Okay, because you are discounting an annuity. Every year you get 160,000. So that's an annuity. When it comes to the second alternative here, don't forget you only discount once. Why? Because you're only going to be selling the building only once at the end of the year. Therefore, this is a single cash flow. This is not an annuity. The 10.6 million this is the amount you'll be receiving at the end of year 8 after selling the building. You can't sell the building twice, so you only sell it once. Therefore, it's a single cash flow. So you discount as a single cash flow. So 1 plus R, that factor. So that's why this is for the first table, this is the second table. Clear?
Okay, thank you. Yeah, it's clear now.
Okay. Any other question? Okay, so another question. No, another application, application, okay, can call it that way, of the concept of discounting, the concept of compounding is when it comes to the preparation of what referred to as the loan amortization. Okay, we'll call loan amortization schedule or repayment schedule. It's no difference. Amortization schedule. Now, what is that? Okay. Now, in case, for example, you are going to take a loan from a bank, from a circle, whoever is going to be loaning you, okay, of course, they'll be expecting to earn interest from your money, okay, from the money they have given you, okay. So therefore, as a customer, you may want to know, if I'm going to take, for example, 1 million today, okay, from this particular bank, okay, how much what should I be required to pay every year, okay? Conventionally, what happens is that you'll be paying an installment, okay, to pay off for the interest, okay, due on the amount you owe the bank. And of course, some amount to be paying will be to take care of the principal payment, okay. So every time you make a payment to the bank, for example, you'll be paying the interest and the principal, okay, where the principal is meant to offset against the loan balance. The interest is the income the bank is earning for the amount you owe them, okay. So in the case of when it comes to preparation of the loan amortization schedule, what the bank is going to be, or even you as a customer, you can prepare it yourself, okay. Most of the bank is going to prepare for you, okay, tell you that this is the schedule, this is how you'll be making the payment, okay. That year one, or if you do monthly, in month one, you'll be paying 10,000 every month for the entire life of the loan, okay. Let's say the loan is for 2 years or 3 years. Every month we shall be receiving from you 10,000, okay. Of the 10,000, there's an interest part of it, and there's a principal part of it, okay. The interest is our income. The principal will be to pay for the loan, okay. Now, a loan amortization schedule just try to show to the customer and even to the bank side, okay, of how much the customer pay the interest, okay, and how much of the payment the customer is making is to offset the loan balance, okay. That simply is what referred to as a loan amortization schedule, okay. It just show the customer that in month one you'll be paying 10,000, but this 10,000 you're paying us, okay, 2,000 is the interest you owe us, okay, and the 8,000 the balance is the amount you're paying to reduce your loan. And that's referred to, therefore, simply as the loan amortization schedule. Okay, so it applies the concept. Okay, if you're to observe that the bank is going to be asking you to have an equal installment every month or every quarter or every half a year, you're paying an equal amount. Okay, you're paying an equal amount. Therefore, since the amount you're paying is equal and is going to be paid for a fixed time period, then we can consider the amount you'll be paying, the fixed amount you're paying, as an annuity. Okay, because what is an annuity? An annuity is an equal amount of cash flow to be paid or received over an equal time period. Okay, so you're paying every month and you're paying the same amount of money. Okay, so therefore we can assume, therefore, okay, that 10,000, for example, you're paying is like an annuity. So you can apply the concept of discounting to determine, therefore, what is this annuity? Okay, you'll be paying. For example, let me give you an example. If, for example, you take a loan, okay. Yeah, as you're taking a loan today, so let me call T note. The loan you've taken is, let's say, is 100,000. The loan repayment period, and the period of repayment, called repayment period, repayment period. Assume you want to take the loan for 2 years. Okay, 2 years. And you're paying monthly. The interest and the principal, the installment payment. The installment payment is done monthly. And assume the monthly interest, okay, assume it is 1%, just 1% per month. A simple example, 1% per month, okay, 1% per month. Okay, so you want to tell me, therefore, if these are the terms, this is the loan you're taking, and these are the period, and this is the interest we paid, how much, therefore, will I be required to pay on a monthly basis, such that by the end of year 2, I'll have fully repaid my loan, okay, the entire 100,000 I've paid back to the bank, okay. Maybe you can say that the installment you'll be paying, since it is equal every month, is an annuity, okay. Therefore, you can say present value, if you remember, of an annuity, okay, which in this case is the installment because it's an equal amount times the present value annuity factor, okay, n years r%, okay. That's the formula which I think we have discussed already together. Now, what's the present value? The present value is the amount you're getting today because this is a loan, it is in T-note, you get the money today. So the loan you're taking is in present value terms already. Therefore, the loan is present value. The annuity is an installment, okay, that you'll be paying every month for the next 2 years. And since it is an equal amount you're paying, therefore, you can use, therefore, the present value annuity formula. 1%, 24 months. Well, now these are the months. So therefore, 2 years converts 24 months, okay? Now, therefore, what's the factor, okay, for 1%, 24 months? Okay, I'm not sure whether our tables have such a thing. Okay, you can use the formula because the tables now have 24. Okay, so you can use the formula. Let's use the formula, okay? It'll be equal to 1 minus 1.01 power negative 24, okay, divide by R 0.01. And assume you're paying at the end of the month, okay? So we don't assume they are in advance, but they are in arrears. Now, therefore, what's the installment? Every month, how much are you required to pay to the bank? You can ignore the decimal in case of your decimal. Do you get it? I hope you get it, because in case you don't get this concept here, then it makes no sense to prepare the schedule. Do you get what we discussed? Okay, fair enough. What's the installment?
707.3.
707.
Yes, 0.35.
Okay, we can ignore the decimal. Okay, someone confirm that answer?
I'm getting the same.
Okay, fair enough. I think I can assume that to be the correct answer. And for every month, for the next 24 months, the bank will be requesting you to pay 4707. Of course, it's a bit easier to plan you as a customer that every month you know, okay, this is the amount I'm going to pay, okay. Of course, within this 4707, okay, a part of it is the interest, a part of it is the loan repayment, okay. So I shared you, try to even give you more details, okay, of the 4707. What is the interest part? What is the principal part of it, okay. Now let's prepare a schedule, okay. So let me show you how to prepare a schedule, okay. And this is what I want to do. I want to ask to prepare a schedule from an example from your examiner. Okay. You prepare this one you just done here. But that's going to be out of work because it means we require 24 months. That's a lot of work. So, yeah, let me get a question from the examiner. Because 24 months means that you need to have 24 individual lines, which is out of work. So let me see if I can get a question from examiner. Then we prepare a schedule. In case you find it, let me know. The exam has to be straightforward. Okay, prepare loan amortization schedule for the company. If you get it, let me know.
Would you kindly scroll up for this?
Sorry?
Would you kindly scroll for this example, the illustration?
I can't hear you very well.
I'm saying, would you kindly scroll up?
Oh, okay. There.
Yeah, thank you.
Okay.
Yeah.
I seem not to get the question. Our latest papers, the one you have. So I'm not sure whether I have to take another question. How comes there's no question that is a bit new? Okay, there's a question here, which was called, it's an odd question. It's December 2014. So I think I'll have to do the same thing. Take a photo and share with you guys. Okay, so I'm sharing the question on the WhatsApp group. Okay, on a question on John Matata. Okay, yes, go through it, then we prepare a loan amortization schedule. Okay, so go through it, we attend together. Okay, I presuppose you have gone through the question. Okay, let's prepare the schedule. Now, in this John Matata, he has just borrowed to 20,000, okay, from a bank, and every year he pays 12%. And you're told that the loan is meant to be paid over 6 years, 6 equal installments. So you're meant to prepare a schedule. Okay, so of course, the first thing to note, how much is he meant to pay every year? Okay, so the first bit is short to get the installment. Okay, so this is a question from December 2014, sitting question 3, Roman 1. Okay. So for the first thing is to get the instrument, okay, and the loan you're taking is 220, which is the present value terms, 220,000. Okay, I can just start from here, no need, but just for sake in case you've been going through it, present value is equal to the installment or the annuity, we just call it the annuity, times present value and factor, n years r percent. So we want to get the annuity, okay? So present value is the loan taken today to 20,000 is equal to the installment, which is our annuity, times present value and factor. The interest per annuity or per year is 12% for 6 years, okay? Therefore, if you go to tables, I think you can get the factor. I think that one should be available. 12% 6 years as an annuity, the second table. 12% 6 years, I get 4.14. Okay, therefore, the installment will be equal to the present value to 20,000. Okay, divided by the factor, which I got is 4.114. Okay, ignoring the decimal. Therefore, how much does John Matata need to pay every year for the next 6 years to clear off the entire 20,000 borrowed today?
53,510.
53,510. Okay, that's the amount that John Matata need to pay every year. Okay, we can prepare the schedule now, therefore. No, the schedule is nothing else other than trying to show out of this 53,510, how much is the interest part and how much is the principal part. Okay, the interest is what the bank is earning for the money they've given you. The principal is the amount you're paying to offset the loan. Okay, so I can have the schedule here. So I can begin here to be here. So this loan balance, carried forward, balance brought forward. What else? Interest. you'll be paying the instrument, the equal instrument you're paying. Then here can be the principal part. Then I can go here, loan balance carried down, loan balance carried down. I'm beginning with year one. The loan beginning of the year, which is year zero, which is today, is 220,000. Okay, goes as for the balance brought forward. The interest you're paying 12%, so the interest is 12% of the amount the bank you owe the bank. Don't forget, you owe the bank 20. Therefore, you pay 12% of that. Okay, therefore, how much do you pay? How much interest do you pay? 220,000 times 12%, of course.
You pay 26,400.
You pay 26,400. That's the amount you're paying to the bank. 12% of 220,000. The loan balance brought forward. Okay, but don't forget you paid how much? You paid 53,510. So since you paid 53,510, 53,510 is what you paid. The balance is a principal. Okay, 26 out of 53,510, 26,400 is the interest. The balance is the principal. What's the balance? Which is simply the difference. 26.
27,110.
27,110. Okay, we get 27,110 to be the principal amount. Okay, now the loan balance, don't forget the principal is the amount you're paying to reduce the amount you owe the bank. Okay, so in year one you have paid back 27,110. You owe the bank 220. So how much is still remaining? Therefore,
220 minus 92,890.
You owe the bank, you owe the bank 192,890. Okay, but that is you're paid back 227,110. Okay, so therefore we can say in year two you still owe the bank the loan balance. Okay, is 192,890. Then you pay the bank the interest on the amount you owe them. Therefore, how much do you pay them? 12% of that.
23,147.
147, 23, 147. But don't forget you still pay 53,510. Every year you pay the same actually. So year 3, year 4, year 5, year 6. So every year can you proceed 53,510 is an equal amount you're paying. 53,510, 53,510, and the year 6, 53,510. Okay. So therefore, how much is the principal?
30,363.
30,363. Okay. Then don't forget at the beginning you owed the bank 192,890. Then you've paid them back 30,363. Therefore, how much do you owe the bank? The difference, that is 160.
162, 527.
527.
Yes.
527. Okay. Now you do that until the end of year 6. Okay. So this balloon balance was 162, 527. The interest. Okay. You can fill out the table, isn't it? Okay. Attempt to do that until the end of year 6. You know the decimal. You can ignore for now. I want to know the loan balance here. At the end of year 6, how much is the loan balance? Okay, there's another question here. In December 2013, question 2C. So let me share the question. Since you don't have the question bank, you don't have the entire question bank with you. Okay, I'll share the question in the group. The December 2013 question 2C. Yes. Take 5 minutes. Prepare the schedule and we confirm. December 2013, question 2C, okay, on the group. So attempt it on your own, then after 5 minutes, come back, we compare the answers, that is. You can ignore the decimal, okay, you can ignore the decimal. Got this? So the discounting itself, okay, the essence we wanted to discuss it was to apply it in the appraisal methods. Okay, if you remember, we started off by discussing that we do have two classifications of the appraisal techniques. We have the discounted, we have the non-discounted cash flow techniques, which we discussed, the two of them, the payback period, and we also discussed the return on capital employed. So the next category was on the discounted cash flow techniques, okay? And that's what I want us to discuss today, therefore, okay? The discounted cash flow techniques, okay? So discounted, okay, cash flow techniques. Now, in the case of the discounted cash techniques, you're going to use three methods. Okay, there are three methods you're going to use: the NPV, the net present value, the internal rate of return (IRR), and the discounted payback period. Okay, so the three methods. So you can begin the first method. Okay, the net present value method. Net present value method. Now, the NPV is simply try to ask yourself that I spent 10 million in this particular project. Now, how much cash flow over and above 10 million has it brought back in present value terms? That's what we call the NPV. I spent 1 million in this investment, in this project, okay? Now, how much over and above the 1 million, okay, has this project bought, how much cash has this project brought back from what I spent? I spent 1 million. So what's the excess from what I spent? That's called the NPV. Simple as that. Okay, you can maybe just put it down. NPV is the excess of sum of present value of cash flows over the initial investment cost over the initial investment cost. Okay, what do you mean? Therefore, NPV is equal to sum of present value of the cash. Okay, let me qualify it by cash inflows minus initial cost. Okay, just like I'll give you an example. You spend 10 million. So you want to know, okay, out of the 10 million, what is the amount of above that 10 million, okay, from this particular project, okay, what's the excess, okay, what is the cash above that 10 million, okay, above the initial investment cost, okay, refer to as NPV, okay. Of course, definitely, if, for example, you have to have, okay, just for example, if the present value of cash inflows, okay, cash flows of project A is $13 million, and the initial investment cost is $10 million, then the NPV, okay, this is just an example, just to say the point. NPV would be equal to the sum present value of cash flow, 13 million, minus the initial cost, 10 million, to give a therefore positive $3 million. Okay, positive $3 million. Now the question remains, therefore, should we invest or not? Okay, should we invest, by the way?
Yes, we should.
Yes, of course you should invest, because you're going to be getting more than what you spent. Okay, you're getting the extra 3 million over and above what you spent. Therefore, sell the project. Okay, if the NPV, just can make that note. if the NPV is positive, then of course accept the project. The project is financially acceptable, accept the project. If you spend 10 million, you got back 8 million, therefore you end up with a negative NPV, then you reject it, definitely, because you're getting less than what you spend, less than the 10 million you spent, okay? If the NPV is negative, reject the project. It is not financially acceptable. What if you get back what you spent? You spent 10 million, you get back 10 million. What should happen there in that situation?
I think you should still reject the project because it doesn't have any economical feasibility.
Okay, at that point, we don't say that you're at a point of indifference. Okay, first of all, you don't lose anything, neither do you gain anything. Okay, so you are at what we call a point of indifference. Okay, if the NPV is 0, okay, the point of indifference, it is a point of indifference. Is a point of indifference. Okay, this you don't gain, you don't lose, so you just remain where you are. Okay, so that we factor as a point of indifference. Okay, now let's do a question.
Excuse me, sir.
Yeah, sure.
Before, so how will we advise an entity in a case of indifference, of a point of indifference?
It's up for them to make a decision. What do you think of this investment? In terms of value created, it creates nothing. You just remain where you are. You spend 10 million, you get back 10 million. It's like you buy an asset, okay? You buy, so that you are a retailer. You buy this particular inventory for $100, but you sell for $100, okay? So I don't know, it's you to make the decision. Is it worthwhile? Maybe you can say, yeah, it's worthwhile because I want to ensure that the customer will come, they can't buy this particular stock, but I want to add more so that they can see as if I'm having a greater number of stock. I don't know. It's a point of difference. In terms of the amount that of value created to you, you don't create anything. But sometimes you can sell, you can decide as an owner of maybe the retail shop, okay? I want to keep this particular stock. I know it nothing, it does not bring anything to me, but maybe because of the sake of my customer, let me just bring it up. I don't know, it's a point of indifference, but as you as the investor, it earns for you nothing, in short. So it's I don't know, there are other factors you may want to consider, but in terms of value created, nothing. It doesn't create the value for you. You just remain where you are. I don't know whether I've explained for you, Michael.
Okay, I have understood.
Okay. Okay, so there's a question that I would want us to discuss. Now, let me take it out and I share with you. This job. So give me a minute. I'll look for the question. Okay. Here's a question. Okay, before you even go to the question, okay, the idea is that when it comes to getting the NPV, or even appraising on any other method, the idea is that you have to be very careful that you only consider all the cash flows that are relevant to this particular project, okay? This is just an example of how you can arrange your cash flows. So it is not that there's any standards you're meant to follow, but this is just an example on how you can use it, okay? So what you can do is that every year, okay, determine year 1, how much cash flow do I get? Year 2, year 3, year 4, until the end of the life of the project, until the end of the life of this investment. So you can organize them on a yearly basis, okay? Then you can consider, okay, how much cash do I generate? How much cash inflow do I generate every year from this investment? Okay, so consider all the cash inflows. consider also all the cash outflows, okay? But first, of course, you have to consider among those cash inflows that I will be receiving from this investment, okay? What are taxable cash flows? So consider them first, okay? Then among all those cash flows, what are tax deductible cash flows, okay? Then the next bit, therefore, okay? Therefore, cash inflow that are taxable minus cash outflow that are not taxable, that are tax deductible, give therefore our taxable cash flows. Okay, then you tax it. You pay tax to KRA. Okay, as a cash outflow. The tax you pay to the KRA is a tax outflow. Okay, don't get is a cash outflow. Okay, the more tax you pay. Then after that, you consider all the other cash inflows that are not tax based. Okay, they are not taxable. Neither are they expenses that are tax deductible. Okay, then you consider them after that. Then you consider what is the total of the net cash flow for the period. Okay, like for this example, okay, which is not the gospel of truth, you can have it changed. Okay, so this example, you have a cash inflow in terms of the sales. So every year the company earn money in terms of cash inflow, in terms of sales. Then it incurs some costs. So inflow sales minus cost will give therefore like in quote a gross profit. But this is not gross profit because these are cash based. Okay, we can say this is the cash flow before taxation. Okay. Then you pay tax. Okay, you have to pay tax based on the amount in quote the profit you've made in quote. Okay, or the taxable cash flow. Then you pay tax every year. Okay. Here maybe okay in year 4 you can see you have tax, and in year 5 we have tax. Maybe what is happening here is that in year 5 okay we are paying tax for year 4. Okay, so the tax are being paid in arrears. Okay, this case the company is paying tax in arrears, like in the case of Kenya. Okay, but in Kenya you pay the same year. I mean, there's some country where you pay the tax okay after the year's come to an end. Okay, if last year you made profit worth 10 million, then this is year 2019. This tax you made profit 10 million. The tax 30%, which give us 3 million, is paid not 2019 but 2020. Okay. Now this is what referred to as tax being paid in arrears. It is paid a year after. Okay. For some country, that can happen. Okay. So therefore, the tax for year 4, okay, is being paid in year 5. As you can see, it is being recognized in year 5 as a cash outflow. Okay. Then you can have cases where, have you done taxation, by the way? You've done tax.
Yes.
Yeah, okay, that makes it. Then I think since you've already done this, okay, the tax authority sometimes can grant you what we call capital allowances, okay, where they can tell you that we are going to give you an option, okay, where you can offset. We are going to give you an allowance that you can use to offset against your profits, okay. If, for example, you earn 10 million, let me just give here. You earn 10 million. Let me call this scenario A. Okay, let me just open better writing area just to illustrate this point on what we call the tax benefits on capital allowances. Okay, just to illustrate this point. Second here, I get my writing area. Okay, so for example, that case here, we have scenario. Let me call this A and this B. Okay, this is cash flow before taxation. Okay, I don't want to call it profit. Okay, but these are tax based. Okay, here they both have 10 million. In scenario A, there was no allowance that this particular company received from the tax authority, or called the capital allowance. Okay, so there was 0. This is capital allowance. Okay, but assume scenario B that this company was granted. Okay, they spent 10 million. Okay, they spent 10 million on the investment. Okay, there's a cost of investment or cost of machine. Okay, cost of machine. If, for example, they're given allowance of 25% per year on the amount they spent, you can say therefore the capital allowance, okay, which I think you have done, is 10 million times 25% to give us 2.5 million. Okay, maybe we'll just do 30% to make our work easier. Okay, so that you're given allowance of 30% on the amount you spent. Therefore, 3 million is what the company is giving. Therefore, scenario B, they have 3 million allowance. Therefore, we can say the cash flow, okay, this is 10 million before taxation, 7 million, then pay tax. In scenario A, you pay 3 million. This is 30%. In scenario B, you pay 2.1 million. You can see that in scenario B, the amount of tax you're paying, okay, is decreasing from 3 million to 2.1 million. Therefore, in scenario B, you are saving 0.9 million. Okay, 0.9 of a million. Now, this is a tax you're meant to have paid, but you're not paid. It's a saving to you as a company. Okay, therefore, this is what we call capital allowance benefit. This is called the capital or tax shield. This is called the benefit you're receiving. Don't forget the difference between A and B is simply on the allowance that B had a capital allowance or tax depreciation that was granted by the tax authority. Okay, it is referred to as tax shield or tax saving. Okay, so therefore every year company B will be having an extra saving compared to company A, okay, of 0.9 of a million, which because definitely is a benefit to the company, is a cash inflow to the company. Okay, and that's why you can see that. Let me go back to that layout. Okay, as you can see here, we are recognizing that the tax benefits as a cash inflow. They are positives. They are positives here. All of them they are positives. Okay, both they are tax saving to the company, so they are like a cash inflow. You're meant to have paid 0.9 million, but you'll be paid. So you save that. It's become like a cash inflow to you as a company. Okay. Let me just go back to the.
Excuse me, sir.
Yeah, sure.
Okay, yeah, I wanted you to kindly repeat on the 0.9, like how you saved it.
Now here, if you didn't have allowance, scenario A, how much tax do you pay to how much tax do you pay to the KRA?
Sorry?
If you didn't have allowance in scenario A, how much tax do you pay?
3 million.
3 million. Okay. Since
Yeah.
you now in scenario B you have allowance, okay, how much tax do you pay?
So less the allowance, I'm saying it's 2.1.
You're paying 2.1, so you're paying 2.1 million. Therefore, in scenario B, do you save money?
Yeah, so in cases of allowance, yes, you said.
Yeah, you save money. So in scenario B, you are saving every year 0.9 million, which is cost definitely a cash inflow. This is the amount you're meant to have paid, but you'll be paying. Therefore, this is therefore treated like a cash inflow. Okay.
Yes.
Okay, therefore don't forget now the difference, 0.9 million becomes for a cash inflow. If, for example, you have to analyze, assume that this is a project B, okay, you are meant to analyze project B. Then every year you have to recognize that you are making a saving of 0.9 million, okay? Therefore becomes a cash inflow in scenario B, okay? Note this 0.9 million is the same as the allowance given to you, okay? The tax saving or the tax shield, okay, is the same as the capital allowance, we just call it CA, capital allowance, okay, CA, times the tax rate. The allowance was 3 million, okay, therefore to be 3 million, times the tax rate, we have it here, 30% times 30%, therefore the saving of 900,000, 0.9 of a million, okay, so the same way, okay. And that's what you get there for the tax saving. Okay, you can therefore make a recognition every year. Clear? Okay. Yes, Immaculate.
Question:
Yeah.
does the tax rate, is it always the same as the capital allowance?
Is the tax rate the same as capital allowance?
Yeah, the rate. Because I'm thinking, assuming the capital allowance had a different percentage.
Yes, it can be different. Like for example, in this case, I assume that it is that percent, but not a must. I think if you remember in your tax, there was some element, some investment that are 100%, other had 30, other 25, I think other 12.5. I don't. You remember that schedule? Yeah, there's amounts that are very different. So this is just an example I took here. This is 30%.
Oh, thank you.
Yeah, it depends on what is the tax, what as per the Income Tax Act in Kenya. Of course, you have to recognize where is this particular asset in, which class is it in, class 1, class 2, class 3, where is it in, okay? Well, the allowance can be, they're different based on what type of investment, what type of machine you're dealing with. Okay, now let's do a question. Okay, actually the idea is to get the NPV is very easy. Okay, the challenge here is about getting these cash flows. The challenge here is about getting these net cash flows. This is where the challenge will be, and of course that's where the marks are. Okay, to discount to get NPV, you simply discount them back to your zero. Okay, you simply the cash flow obtained here times the factor from the tables. Then the sum of the NPVs give some of the present value give us the NPV. So NPV is very easy to get. So there's nothing harm. Okay, but the idea is that you can see most of the works are before getting the cash flows. Okay, and that's why you have to be very careful when it comes to getting the cash flow for each year. That's why you have to be very careful. Anyway, let's do an example here. So go through this. In the next 2 minutes, we attempt it together. Okay, an example, we want to get the NPV of this investment. Go through it. Okay, I suppose that you have gone through the question. Let's attempt the question together. Now, in this question, we told that the company want to buy some machine here, and the produce for the machine every year they shall be receiving 1.4, 1.3, 1.5, 1.6, 1.9, year 1 to year 5, and every year the cost they shall be incurring is equal to 0.7 million. Okay, so therefore we can begin there. Determine therefore what is the cash flow to be received before you even consider tax. Okay, have it here. So let me arrange them per year. So let's put 0. Okay, you can have year 0 in year 1, year 2, year 3, year 4, year 5, year 6. You can have your sales amount you receive from sale. Year 1 you get 1.4. Okay, let me have them in thousands of pounds. I think the best thing I take is an image of the question to avoid this back and forth. Okay, so year 1, 1.4, year 2, 1.3, year 3, 1.5, year 4, 1.6, year 5, 1.9. Then you told every year the cost you incur is 0.7. So cost you incur is 0.7. Cash outflow because you're paying is a cost. Okay, then this 700 net. This is 600. This is 800. Is it 100 or? Yeah, 800. This is 900. This is 1200. Then I'll ignore it. You can ignore, okay, or you can put what you want to prefer. Let me just choose this for the time being. Let's ignore the impact of the allowance given. Okay, so therefore the tax, in this case I'm assuming that we don't have allowance. Okay, if you know the allowance, so you pay tax at 30%, and the tax here, we told that the tax is payable in the same year it is generated. So the tax for year 1 is paid in year 1, tax for year 5 in year 5. So you don't really even in year 6. Okay, therefore tax for year 1 you pay 210, 30%, 180, 240, 270, and 360. Okay. However, we know that the company has been granted an allowance by the authority of 25% reduced in balance basis. Okay. I hope you do know how to get the depreciation based on straight line method, using balance basis, double decline in the method. You know this method. Okay. So I suppose you do know. So so here for this example, you'll be told we use reduce in balance basis when it comes to getting tax depreciation or the capital allowances. Okay, So let me have work in here. Okay, so this is on tax savings. Yes. Okay, and we can have them here, tax savings. So the first thing I need to get is the allowance for each of the year. And you'll be told the cost of the asset is 2.2, so 2.2 million times the depreciation, the rate of allowance given, which is 25%. So the allowance for year one is 550,000. The balance brought forward is 2.2 million minus 550,000. You get 1650 times 25%, and you get 4 million until 500. Then the balance brought forward year three, okay, is 1 million. 2, that's 7,500. I'm not sure about these figures. Confirm times 25%, and you get 3.
$309,375.
309,375.
309,375.
309,375.
Yes.
Okay. Then actually we have year 5. So we also have year 5. So the balance for year 4, the balance is 1.2 minus 309, and we get how much?
928, 125.
125 times 25% to give us 2.
232 and 31.
That way.
232,031. Yes.
Okay, 2, 031 come there for the allowance for year 4. Now year 5, the final year. Don't forget, by the end of the asset life, you need to have claimed whatever amount you spent on it, less anything you got back from its sale. Now, for this asset, you'll be told that at the end of its life, it has 0 value, so you won't earn anything from it. Therefore, the total amount you have spent on this asset is 2.2 million. Therefore, by the end of year 5, the total amount you can claim, therefore, is 2.2 million. Therefore, how much do you claim in year 5? The balancing figure. Okay, which refer to as year 5 as the balancing allowance. Year 5 we claim, recall, the balancing allowance. Therefore, what's the balancing figure? Don't forget year 5 is the final year. That's why you have the balancing allowance being claimed in year 5. How much can you claim in year 5? Which is 2.2 minus the sum of the allowance year 1 to year 4.
696,094.
696,094. Okay, and don't forget these are just allowances. They have no tax impact, or they have no cash flow impact. What has impact is the tax savings. Okay, don't forget these are capital allowances. So our main concern is on the tax savings or the tax shield. If you remember the example that we did, let me just take you back there. This example, into the tax saving, okay, is equal to the allowance times the tax rate. The allowance times the tax rate. Okay, for example, it was 3 million times that %, and we got 900,000. So therefore, the tax saving is the allowance times the tax rate. Okay, the allowance times the tax rate. Therefore, it's 550 in year 1. Okay, 550 times 30% to give us the tax saving. Okay, and we get how much? 165,000. Confirm? I'm not sure.
165,000.
Okay, year 2.
123,750.
123,750 that way.
Yes.
Okay, year 3. 90.
92,798.
798. Thank you. Year 4. 60.
Year 2, I'm getting 92,812.5.
12. Year 2, that is.
Year 3,
Year 3, 92, 812.
92,812.5.
Okay, someone confirm which is which?
Getting 92,812.5.
Okay, maybe that's where they have some, maybe 812, 92, 812. Okay. Year 4?
69,609.3.
699. Year 5? 2?
208,823.
823 to 823. Okay, therefore the tax savings. That's
Sorry, 828.
sorry,
828.
828, 828. Okay, that's kind of the saving the companies will be making because of the allowance given to it by the tax authority every year. Now these are these have cash flow impact. Don't forget these are non-cash flow, but this has cash impact. Therefore, see the savings, they are cash inflow. Then we can have here another column, another row, sorry, for tax saving. Year 1, okay, my figures are in thousands. Okay, so I'll just put the nearest of 1,000. So I got year 1 is 165. Is a cash inflow positive. Then I got 93 to the nearest, 70, 70. Then I skip 1 year. 165, 93, 70.
You skipped 1 year. You skipped 1 year.
Let's keep. Oh, 123.
Year 2.
Oh, year 2, yes. Okay.
Year 2.
It's 124. Year 2, 124. Yes, thank you. Then 93. Then 70. And last we have 209. Okay, don't forget they're positive. They're cash inflow because they're savings. Okay, you could have paid, but now you won't be paid. So the cash inflow, money has been left in your pocket, in quote. Okay. Anything else? And that is it. There's no working capital in this question. Okay. There's no scrap value. And that is it. Okay. Then here I can call this my net cash flow. Here 1, what do you get?
$655.
655. Year 2.
544.
544. Year 3.
653.
653. Year 4.
560.
Year 4, 560.
Yes.
700.
No, I doubt that because it should be 700. Year 4.
700.
700, yes. Should be 700. Year 5.
1049.
1049. Year 5 cash flow. Okay. Now these are cash flows. So
What about, excuse me, sir, year 3?
Year 3, I don't know. 800 minus 240 plus 93. What do you get?
Yeah, it's okay. It's okay.
Okay.
Yeah.
Okay. Now these are cash flow. Therefore, the next bit is, of course, is just to get the present values because we want to get the NPV. So therefore, we can get present value interest factor from the tables. We are discounting at the company cost of capital. Okay, we'll be told that this project, the company has a cost of capital of how much? 15%. You can see the firm has a target return of 15%, which is simply like the cost of capital, 15%. So we discount at 15%. And because these figures, we can get them from the tables. Okay, we get them from the tables. Okay, so don't forget we are discounting every year. Okay, so therefore use the first table. Okay, so you're discounting at 15%. So 15% year 1, 86.96. Year 2, 25.16. All the way to year 5, and the factor for year 5 is 49.2. Therefore, the cash flow in the factor gives us the present value. Year 1, year 2, year 3, year 4, year 5, and you get the present values here. Okay, do that. Once you've done that, you have obtained the present value for each of the year. Okay. The next step is to get the NPV. Okay, the NPV we said is equal to sum of present value of cash flows, what you're going to obtain from your analysis there, minus initial cost. And the initial cost is 2.2, but the cost of that is 2.2 million. Therefore, it'll be equal to the sum you're going to get minus 2.2 million, and you get the NPV. And then you advise the company. So get the NPV, then you advise the company. Let me know once you have the NPV. Just seen I forgot to record. Yes, okay, I don't know. I can just go through this question because to capture the question. Yes, what is the question? Or you
I wanted to sign.
to sign, you can still sign. Go ahead. Okay, let me allow the system to capture if it has not done so. Okay, fair enough. We can meet on Wednesday and we do some question from your examiner on the NPV and the internal rate of return. Okay, so if there's no question, then I think we can meet on Wednesday. Don't forget to sign. Enjoy your evening.